Okay, welcome to our webinar today. We're all about investment philosophy. We're going to run through the performance of the Scientiam model portfolios. And so what we'll do every month, we're going to run through some certain topics, give you an update on what's going on, how your portfolios are tracking, and recap on some of our investment philosophy. So to start with, I'm just going to run through our investment philosophy. It's really important for everyone to reiterate the story of why we believe this way of investing is the best way, and there's so much data to back that up over decades and decades and decades. We're not holding a hand up saying we invented this by any means, but what we do want to do is share this knowledge with you all. And when we look at it, what we really want for all investors is that you want peace of mind. At the end of the day, you want your investments. You don't want to be worrying unnecessarily about your investments. You certainly want security, that you know that they're relatively safe in light of your risk profile. You don't want to wake up and think, well, that might have disappeared, or that could be something that's worth zero. You want the confidence that the systems work and there's a process. Obviously, you want to maximize your investment returns. That's why we're all here. And we want to set the expectations about what to expect and what sort of market returns to expect over time. And we want to really understand what you can control. We'll be honest, we don't know what's going to happen in markets. We just don't. No one really does. So what can we control? If we can't control markets, then what can we control? Let's go through that. What we do want is clear expectations around those returns. So what to expect for a different risk profile. We do want lower costs. We do want reliability and certainty. That's an absolute given. And we want to know that this philosophy's stood the test of time. What happened in 1982, 83, 84, what happened in 87, what happened in 91, what happened in 95, we can see the data. Like, this is something, these investments that we use have been around for a long time. It's sort of new, but it's not. So the sort of things we avoid are obviously investments that have just started up today or don't have any research to back it up, or it might work, but we just don't know yet. So it's not worth taking that sort of risk. We have an investment philosophy. It's really important to stick to that philosophy. It keeps it structured. It gives us a range of decision making, so we know what we're sticking. That doesn't mean that new things can't come into that, but you've got to have a structure and a discipline around it. There's a governance role when people are managing money, of course, and over time, there's so much evidence to show that having something you can stick to, a written plan, a philosophy around how you invest is really, really important. So you can stick to it, because things will change. There will be all sorts of events that come up that challenge your investment thinking and maybe make you think that you've got to change. And time again, you can come back to those fundamentals. So you want to reach your investment goals with as much certainty as possible. And so at Scientiam, we say no to a lot of things. We say no to high costs, investments with high costs, funds with no research, funds that are liquid, that don't have that have a high gearing, for example, which is debt, that advertise a lot. Like, so, when we mean that, we say often there's a warning sign when there's a certain investment fund that's on the front page of the paper all the time. Doesn't necessarily mean it's bad, but a lot are being advertised for a reason. And if they're conflicted, we don't want any conflicted products, of course. We don't want any conflicts. So we want to create a strategy around what you can control. What you can control is your asset allocation. You can control your decisions around that. You can control how much you contribute. You can control, how that portfolio is structured, and you can control things like your diversification. To an extent, you can control your expenses, turnover, and taxes. You can make choices around that, and you can control the discipline. It's hard because our emotions get in the way. That a very well-known academic who won a Nobel Prize is Daniel Kahneman, written many books on this, and his whole theory explains, or one of his theories explains, how as humans we're wired the wrong way for investments. We tend to want to do the wrong thing at the wrong time, and the media plays on that. The media makes us nervous, wants to sell, when markets are low, and all that sort of thing. So you've got to really understand how emotions can get in the way. And that's when we talk about beware of the noise, like the media. So one day they'll be talking about this and people go, oh, that journalist said that's a great idea. The next day they're talking about something else. So you've got to be just aware of what they're playing at. They're not predicting the future. They're writing a story that's interesting right now, whether it's cryptocurrency, for example, but next week they might say cryptocurrency is no good. Like, I'm not So you just got to be aware of why they're promoting things and what they're talking about. And that's newsworthy. It doesn't necessarily mean it's good or bad. But obviously fear sells, and you're not going to sell papers every day if you just say, hey, stick to a long-term strategy. They need to here's a manager that made X% last year, and here's the hottest idea. That gets people's interest. So you just got to avoid some of that in terms of, well, not necessarily avoid it. It's interesting to read, but make sure you're aware of how that might play out in your portfolio. Because when it comes to timing, we're often asked about, oh, surely someone can time the market, or I'm just going to hang on and wait for the right time, or I'm going to sell now and wait and buy back in. And we look at the stats there, we look at the evidence and say, well, if you were invested in the ASX 300 from 2001 to 2020, and you just invested in that market, you got 8.1% over that period. But if you missed the one best day, then you only got 7.75%. If you missed the 5 best days, 6.57. So not too bad, but that's only 5 days. But suddenly, if you miss the 10 single best days in that whole period, your return is now almost half, 4.25%. If you miss 25 days, so that a lot of people would do that, they're in and out, you're down to less than cash. So the Bloomberg Ausbond Bank Bill Index is just cash. So it's very, very difficult. It's very hard to find anyone over time who's done this successfully. It's really proven to show that you can't do it with any reliability. And then we look at the research and say, well, if people are managing their own, what do the stats say? The stats say that basically it's very, very difficult to manage money on your own and do well. Now, we see all sorts of stats and statistics around this. A big company in the US, again, called Dalbar, manages money or does a lot of statistics around managing money in the US, a lot of data over there over time. And what they look at is, well, how did the individual investor go? Now, we all know a friend or family friend who's made money buying stocks, and that's not impossible. We're not saying that's not impossible. We're just saying over time, is that a reliable way to manage your portfolio? When you could get 8.2% compound, that's actually a pretty good rate of return. But the average investor is shown to get 4.7. And the key reasons are they're in and out all the time. They're trying to time things. They've got more expensive costs, transaction costs, turnover taxes, and their emotions get in the way. So that's not a great outcome. So again, how to avoid that? We want investors to try and avoid that, invest in a much smarter way. And we look at the different styles of investing, and you've got your home trader. There's no data on that really, so it's unlikely that we're going to be able to really rate that. But the reality is, if the huge hedge funds and stock pickers in New York and Boston and London aren't on by average adding value, then how can someone in their home computer? So we look at that, we look at then the index managers, and we look at evidence-based. And what we're looking at is saying, what's the chance of outperforming? Now, the chances of an active fund manager outperforming is actually very slim. We'll go through that in another webinar. There's data on that by Standard & Poor's showing it over time. It's less than 10% of active fund managers actually add value, and actually gets lower than that, but that's 10%. So it's a slim chance. Is it, so is that a game worth playing? And then you look at pure index managers, which are great. They're very low cost, but again, there are some slight inefficiencies, and we like index funds. Certainly for some asset classes, they're fantastic. But then we look at this evidence-based investing. So the fund managers here, they take another view. They're like index, but they actually take a view of certain parts of the market and try to tilt to those parts of the market, but still keeping costs low, still keeping the turnover relatively low. They're trading, but they do it in a much smarter way. And their track record is outstanding. I mean, this is performance that goes back to the 80s. So when we look at it, we go, well, why wouldn't we use the best possible managers? We've been doing this for 30, 40 years, rather than a manager who's just popped out of the sky in the last couple of years and is outperforming for a couple of years, but the chances of them being here in 30 years is very slim. Now, when we look at the investment philosophy, most people understand why they have to invest in the long-term returns, but it can be, some people do still say all the time, oh, I'm not going to invest, shares are too risky, or I don't know what's going on in markets and whatever. And you think, well, over time, capitalism, the capitalism market basically says you're going to get a return if you take money out of cash and put it into something a bit riskier. Now, it doesn't happen every day, unfortunately. So that's what people lose a bit of faith in it. But unless we're going to basically move to well, North Korea or perhaps Cuba, where there's no free market, then really we've got to have a bit of faith in the market that this does work. And yes, it can be scary at times, but there's volatility, but you've got to trust that market and know that you're going to get a better return out of cash if you simply invest in markets or property or something that's got potential to grow. And then to make it better, we have to make that decision. We have to say, well, how much are we going to leave in cash and how much are we going to leave in shares and property? And now we look at some portfolio simulations, and we'll come back to this. We start to look at the mix and go, well, if we're able to get 8.13% just by simply having 70% in the market, then that's not a bad outcome. Now, today's webinar, I'm not going to go into this in a lot of detail. That's for another one, which is a lot of detail, how we can break up certain mixes and show how diversification can work and add value. So what we want to do then is break it down into, we're going to invest in domestic shares, our local shares, international shares, and emerging markets. And everywhere in the world, you tend to have a bias to your home country. That's natural. But if you looked at the world and said, well, Australia makes up 40% of my portfolio, it doesn't make sense if I was sitting in the US or London, but it sort of makes sense if we're here. So we've got to bear that in mind, that people will have a natural bias to their home country. But obviously, when you look at the world market, Australia down there is 2%. US is still huge in terms of the stock, markets. That's not the size of economies; it's the size of the global markets. Most of the big companies are still listed in the US, and that's where a lot of the stories and a lot of the investment activity is. So then people say, well, I don't want to be in a certain market. I don't want to be in the US. Things aren't looking good there. I don't want to be in China. Don't want to be in it. And so we sort of look at that and go, well, okay, well, if we were trying to pick which market to be in, can you do that? And this is ranking the best asset class to the worst. 2006, the best was Australian small companies and the worst was fixed interest. In 2007, the best was emerging markets, the worst was property. And we can take that through. We look at this chart, and actually there's one that's very similar to this, but it actually does each country. And it just shows, well, there's no pattern there, right? I can't sort of pick one and say, look, I'm going to stick with that. It's up and down. If we tie this in with the news at the time, it's really, really difficult to sit here in a certain year and say this is definitely going to be the best possible asset class. You're just taking bets. And it's a bit like an analogy of sporting. As you go to a sporting game and it's 90 minutes or so, and there might only be 1 or 2 goals or 4 or 5 tries and things like that. Or in a cricket game, it goes for days and you might miss that one crucial wicket. So if you sit in your seat for the whole game, you're going to catch it all. But if you decide to get up for half an hour, you could miss that goal or that wicket. So investing, you do have to stay in your seat. You have to diversify, decide on what's right for you, and you do have to stay to your seat to a certain extent. You can adjust it slightly, but you don't want to be making big calls and saying, oh, I'm now out of the US. I've read something in the paper and it's clear that the US is in trouble. Well, that's very, very difficult to predict and is shown to not really work. So then what we do, the portfolios then tilted to small companies, value companies, and profitable companies. So there's a lot of work going on here to say, how do we get the better return just from purely making a decision to invest in equities, to say, well, now we're going to invest in different parts of those markets, domestic equity. And interesting here, we're not talking about a specific stock. We're talking about a particular part of the market that we're going to tilt to. We've got data to show that those tilts actually add value over time. And here's again, a lot of data, actually probably another whole webinar on that in terms of value premium and small premium and profitability premium, but there's data to back it up. All of this has got data to back it up. We don't just say, oh, let's tilt to value, that would make sense. And then fixed interest the same. We don't just buy long bonds. We look at the research and say, what market do we want to tilt to for a certain risk profile? Global bonds. And in bonds, it's all about term. So the duration of the bonds, is it 10 years, 20 years? And the credit rating, is it a great country that we believe is going to repay us? So Australia's up there. Or is it a country in the world where we're basically lending money to Venezuela? We don't know if they're going to pay us back. So that's not great credit. But and the same with companies. You've got great companies, top 10 ASX listed, probably going to pay us the money back. But a really small cap, maybe there's a risk. There's a higher risk. They might not survive. So we look at these portfolios. There's, of course, our disclaimer, obviously general advice, of course, as per everything we're doing with Scientiam. But we look at the mix there and we can just track it. The data shows as we go from conservative all the way up to high growth and the expected return and the higher risk. So if you're high growth, you've got thousands of stocks in that portfolio, but it's riskier than the conservative fund. Riskier because in the short term, it could fall more in value. It's not riskier that you're going to lose your money. It's just that you need a longer time horizon, because in the near term, you could have just that higher level of volatility and fall. So what I'm going to do, I'm just going to share another screen here and run you through actually some of the data. So if we look at some of the portfolios here, this is the Scientiam 99, it's our highest growth portfolio. A few things here that are interesting. Is that working? I think so. We've got 6,048 different securities in this portfolio, and its performance over time, this is actually now the moderate growth sustainability, sorry, and it's 1 year is 14.87%, and over 10 years, 11.27 now. So we've got all the stats in there. We've got these on the website. You can have a look at these. There we go. There's the 99 growth. Oh, we don't want to change its name. And when you look at this, the high growth portfolio, its 1 year performance is 22.59%, over 10 years, 13.5 now. It's got 7,996 different securities. I'll close that one. And let's have a look at some of the others. We even look at the really conservative, the Scientiam 3. This is the, still jumping always to that one, Scientiam 7. Here we go. Here it is, the conservative portfolio, 7,802 securities, really widely diversified, and the return, obviously it's the most conservative, only 5.64, but that's pretty good, a lot better than cash last year, and 10 years 6.02. So this is very conservative. A lot of our Scientiam customers are not in this fund, but just to show you the range of returns that we've got across the portfolio. So these are all available. You can log in and see all these at any time. We'll go through these, we'll go through some market updates, but what we've seen is a quick market update of the last year, end of December, good times. January's been a bit bumpier. We've seen a negative month, which obviously happens from time to time, and a bit of uncertainty around interest rates, inflation, those sort of things. But long term, if you're investing for the next couple of months, yeah, you might be worried, you might hang in cash, but if you're investing for long term, these sort of things shouldn't worry you too much. You stick to your plan. You might shift your asset allocation a little bit. It might make you revisit a few things. But for the longer term investors, nothing too much to worry about. These things happen in markets all the time. So I hope that's been really informative. Please add your comments, go onto the site, ask us questions. It's great to have you on board. We're building fast. We've got lots and lots of people joining up now. It's really great. So if you've got anyone you could share this with as well, we'd love for you to share it, of course, and reach out to the team if you've got any questions. Again, I do need to reiterate, it's all general advice in nature. None of this is specific to your personal circumstances. If you do have specific requirements and need personal advice, reach out to your linked advisor on the site. Thanks so much. Bye.